Hi, good morning. Sorry for being a couple of minutes late, just getting the technology in order here, but good morning, welcome. Welcome to Wilshire Finance Partners and our presentation on year-to-date 2025 results and near-term outlook. We've got a number of folks, it looks like, that have joined the call. It looks like we've got a couple of existing investors, and we've got some other people who might be new to Wilshire. So by way of introduction, Wilshire Finance Partners is a real estate finance and investment company. We were formed in 2008. Our focus is on short-term fixed income investments, real estate secured private debt. My name is Don Pelgrim. I am the Chief Executive Officer of Wilshire Finance Partners. I also manage the WFP Income Fund, the WFP Income Fund REIT, and the WFP Opportunity Fund. I am a former banker and I'm a licensed attorney. The purpose of this presentation, as I said, is to do a recap of our year-to-date performance, talk about near-term outlook, and discuss deal flow, lending activity, and some of the strategy. I invite you and encourage you to ask questions. You can submit them online during the presentation. I do have a lot of material that I'm going to try to quickly cover today. So my goal is to answer those questions at the end of the presentation. And it's very possible that some of those questions will be addressed during the presentation itself. So in terms of a little bit of housekeeping, this presentation is for educational purposes only. It's a summary. It does not cover all the risks and rewards of investing with Wilshire. It's not legal, accounting, or investment advice. It's not an offer to buy or sell securities. We are going to discuss historical performance of the funds, but past performance is not indicative of future results. We will also cover certain forward-looking information and statements, and those are subject to change. All investments involve risk, so you're encouraged to investigate and review both the risks and rewards prior to investing. So with that, let's talk about the WFP Income Fund and year-to-date results. So real quick, the WFP Income Fund is a real estate debt fund. It invests in first trust deeds and mortgages at lower loan to values. And the fund is designed to deliver a balance of stable income and principal protection. For the first half of 2025, we were able to deliver a 9.26% net annualized non-compounded return. That is the return paid to investors net of fund costs and expenses. Since its inception, the fund was able to deliver a 10.16% compounded return. That was from September of 2013 through June of 2025. And again, that is net of fund costs and expenses to investors. We had a 54.94% weighted average loan to value at the end of June. So that means about a 45% protective equity cushion. Why is that important to investors? Well, it helps to protect your principal investment and helps to protect against downside risk because borrowers have skin in the game. It reduces the probability of default, and it also lessens the impact of a default should that actually occur. 30-month weighted average maturity. Why is that important? Well, we invest in short-term loans. And what that does is it gives us a real-time look at what's going on in the real estate market and make adjustments to our underwriting as we're writing new loans, very different than a static loan pool or a CMBS where you've got a set type of loan or the set loan itself within that pool. Ours is a little bit more dynamic. And it also creates internal liquidity within the fund to meet redemption requests and to make new loans. Another cut at the income fund through a couple of charts. We see a dip in 2020. So historically, we increased the loan loss reserve during COVID. It didn't represent a loss in the fund, just an increase in the loan loss reserve. For people that are new to the fund, that's another protective measure. It's a set aside, sort of a banker's concept, rainy day fund, just as an additional buffer. Then you'll see that returns increased, and right now we're a little bit over 9% annualized. result of loans at lower yields rolling off and new loans at higher yields coming in. And what we've been doing over the last year or so is writing loans on an adjustable rate basis with a floor that helps us to get a little bit of an increase, but also lock in the downside a little bit. The compounded return since inception, as we said, is 10.16% from September 2023 through June of 2025. Net asset value since inception of the fund, over 11 plus years, pretty stable, maintains stability because we're not correlated to the stock and bond markets and have little to no sensitivity to interest rates. Opportunity Fund 2025 performance. This fund is also a real estate debt fund. It is invested in first trust deeds, mortgages, subordinate debt, second trust deeds, and other forms of debt. We don't have equity in that fund because we've got some ERISA money in there, and ERISA money with other forms of equity, for example, may create an adverse tax consequence called unrelated business taxable income. So we don't do equity out of that fund. Designed to deliver a higher risk-adjusted return. And in the first half of 2025, we generated 7.43% net annualized non-compounded return. Again, net of fund cost expenses, the amount paid to investors. 13.27% compounded return since inception. It was formed at the same time as the income fund, September of 2013 through June of 2025. That return largely driven by investments and returns on participating loans in past years and quarters. Weighted average loan to value of 62.24%, just about 37%, 38% on the protective equity cushion, and same reasons why that's important to help downside risk protection, help protect the investor's principal investment in the fund. 34-month weighted average maturity, similar reasons to the income fund why that's important. Real-time look at the markets, underwriting adjustments, and internal liquidity within the fund. Couple of charts for the Opportunity Fund, non-compounded return. We saw an increase in year-over-year returns. Again, new loans being made at slightly higher rates, using an adjustable rate loan with a floor predominantly, and the compounded return since inception, we said in the 13% range. Now the share value of the Opportunity Fund, a little different than the income fund. You saw a flat line or a lot of stability in the income fund, NAV. The NAV fluctuations in the Opportunity Fund, it's not correlated to the market and not sensitive to interest rates, but the peaks and valleys relate to the accrued unrealized gain on certain participating debt that we've had in the fund in the past. And what happens is you accrete that gain, and when you realize that gain, you distribute the gains, you go ex-dividend, and that's why you see these peaks and valleys there. It's not related to the marketplace itself. So with respect to the near-term outlook, we're going to be talking about new legislation that has went into effect, and the reason that becomes important is that we have a downstream real estate investment trust in the WFP income fund, and our investment thesis is that we like meds, sheds, and beds, and under that med category, that includes senior housing, and new legislation has some impacts on senior housing. So I'm going to be talking about that and going into a little bit of detail here in some areas of this discussion. So I want you to hang with me, and we'll be able to cover any questions that you might have as well. So the REIT dividends were subject to a 20% reduction that came through the Tax Cuts and Jobs Acts of 2017. It created qualified business income deduction under Section 199A. And the way that 20% deduction in REIT dividends works for individuals is that if your marginal tax rate is 37%, the effective rate on the REIT dividend drops to 29.6% after that 20% reduction. So it's an attractive feature of that REIT pass-through. And the impact is that it increases the after-tax yields to investors that receive that REIT dividend. Now, that was set to sunset December 31st, 2025. And the legislature, through its debates, were talking about increasing that actually to 23% as part of an original proposal. But with the passage of the One Big Beautiful Bill that was signed into law July 4th, 2025, the deduction remained 20%, which is attractive, but it's also now permanent. So the importance of that is that tax efficiency of that 20% deduction remains in place, and it's in place indefinitely, and that creates a little bit of stability for people who are doing planning. Now, could there be a potential change in that in the future? Yes. That would require new legislation to change that deduction, but for now, that remains in place without any sunset. So what is the impact of this new legislation on senior housing? And this is where I'm going to get into a little bit more detail. Well, I'm going to give you an overview just to set the stage, so to speak, or to set the table on Medicaid versus Medicare, the broader impacts on senior housing, who's impacted, impacts on different asset types such as independent living, assisted living, and memory care, behavioral health, and what actions different people are taking within the marketplace. So there's a lot of detail and differences between Medicaid and Medicare. Um, the primary differences really rest with who sets the direction, how they're funded. Under Medicare, on the right-hand side of the chart, Congress on a federal level sets the direction of Medicare. Under Medicaid, it's really joint and federal programs, and the legislatures, both on a federal basis and a state basis, set that direction. Funding is also a little bit different. Medicare comes through payroll taxes, premiums, deductibles, copays. But under Medicaid, you've got a mixture of federal and state funding. Some states have a small copay that comes from the beneficiaries, but usually that results in a lower out-of-pocket cost for the people that use Medicaid. Medicaid is state-run. Medicare, federal basis. You've got some portions of the Medicare program might be managed by private insurance companies under, you've heard Medicare Advantage, which is a bundled plan, but for the most part, you've got federal setting the tone, and how it's administered and the benefits are similar in each state. Conversely, on Medicaid, because you've got state legislatures involved and eligibility and coverage varies by state, you've got this variation state by state, but it offers services that Medicare does not. Eligibility is also a little bit different under Medicare. Anybody who meets the age or disability requirements, regardless of income, would be eligible for Medicare. People who meet the income and asset requirements under Medicaid receive Medicaid regardless of age. And that's important on both sides of the table because of seniors and the 65 plus community. There's a concept of dual eligibility where people can qualify for both Medicare and Medicaid, and that typically would involve low-income individuals with complex healthcare needs. Costs generally free for Medicaid. Some states, as we said, charge a small fee. Medicare premiums set at the federal level with annual deductibles and coinsurance amounts. And coverage differs a little bit under Medicare and Medicaid as it relates to senior housing. a little bit more benefit and a little bit broader services offered through Medicare as opposed to Medicaid. So with respect to assisted living and Medicare, the federal program, what it doesn't cover, for assisted living facilities, it does not cover things like room and board, such as your living space and your meals. It does not cover personal care or custodial care, such as bathing, dressing, eating. Does not cover long-term care. Conversely, um, it will cover certain types of care, such as doctor's visits or skilled nursing care, within the assisted living setting, if those were also covered under Medicare otherwise. So in other words, even though you're living in an assisted living facility, you still may be able to get some of those benefits. Now, under Medicaid, which is a state-run or co-run program, similar to Medicare in that it does not cover room and board, but under the home and community-based waiver programs that state put in place, that's a program that allows individuals to receive assisted living services while remaining in the assisted living facility rather than going, for example, to a nursing home to get care. So it expands the coverage to those individuals in an assisted living facility and does cover things like personal care, assistance with activities of daily living like bathing, dressing, eating, so on and so forth, medication management, case management, where a case manager may help to coordinate care, transportation to and from appointments, and nursing services. So the new legislation impacts Medicaid, and what I'm going to do is give you just a broad overview, generally of the funding cuts, provider tax reduction, what that means, eligibility requirements, and the additional bureaucracy that folks are uh, impacted by here. So generally, when we talk about funding cuts, it's anticipated that over $1 trillion plus will be cut from the program over a 10-year period. And it's estimated that 11 million individuals will lose coverage by 2034. As of March of 2025, there were approximately 78.6 million people receiving Medicaid. So an 11 million loss in individuals receiving coverage is about a 14% reduction in the number of people receiving Medicaid. As of February 25, approximately 6% of all people receiving Medicaid were eligible non-citizen residents. So roughly half of that 11 million falls into that category. And this information comes from Kaiser Family Foundation research. We talked about the Medicaid waiver program and home and community-based services. That's what's being impacted here. And what happens there is you've got states that use Medicaid funds for non-institutional long-term care, such as assisted living, home care, and adult services. The provider tax reduction, to explain that, there's a provider tax. So there's a tax on hospitals, nursing homes, and other providers in a state. And what happens is the state taxes those enterprises, and then that tax is used to determine the match funding under Medicaid. Now, there's this concept of being held harmless. So if you're paying that tax as a provider, that tax might be higher, but you theoretically get a higher reimbursement through Medicaid matched funding. Under the new law, the impact is that the provider tax drops from 6% to 3.5%, which reduces that state revenue, that state tax that is being received. And as a result of that, it lowers the matched funding. And the impact then is potentially a lower reimbursement for Medicaid on a state level basis, unless states make up the difference in the reduction. Eligibility and work requirements. The new work requirement is 80 hours per month of work community engagement, job training, or going to school. And implementation of that particular provision is December 31st, 2026, but states can elect to implement that a little bit sooner. And there are reporting requirements that are associated with that. Every 6 months, the individual receiving Medicaid needs to prove their 80 hours a month of work. But there's a bunch of exemptions for that requirement. One of which is adults age 65 and older, which would be those assisted living residents. So they don't have that eligibility requirement to receive Medicaid. The average of individuals in an assisted living setting is their late 70s or early 80s, so they fall within that exemption. There's more paperwork, there's more bureaucracy associated with this type of funding now, more frequent eligibility checks every 6 months versus annually. There's more documentation requirements surrounding citizenship and other things. So the result of that is that you'll see a little bit more administrative delay in the receipt of that type of funding. So the impact on seniors and again, how this is going to become relevant will hopefully, as we're discussing this, you'll see that the seniors that are most impacted are those that frankly are reliant on those federal and state programs. And those would include the non-US citizens and mixed status residents, lower income seniors on Medicaid and Medicare, those dual eligible folks, seniors in facilities that are dependent on Medicaid reimbursement, skilled nursing facilities, behavioral health clinics, assisted living facilities that predominantly rely on Medicaid waivers, and behavioral health patients and seniors that have cognitive impairment. And a lot of that has to do with being able to navigate the paperwork and the additional eligibility requirements. The seniors who are least impacted are seniors that are not dependent on federal and state programs or Medicaid reimbursement. Those are the private pay facilities or the assisted living facilities that have a much lower reliance on Medicaid waivers and that type of reimbursement. So as a result of that, those facilities really don't have any immediate impact on revenue or operations. So what I'm going to do now is take that new rule and kind of talk about each different segment of the marketplace: independent living facilities, assisted living facilities, memory care, continuing care, retirement communities, behavioral health facilities. There's also an impact on hospitals and skilled nursing facilities. We're not doing any lending or investing at that level of acuity or that type of facility. So I'm really not going to touch on those, but I will touch on these others. Now, what's interesting is that independent living, assisted living, and memory care facilities, CCRCs, very similar impact for those types of businesses. A little bit of a different impact for behavioral health facilities, and that has to do with the revenue streams and residents in those types of facilities. So with respect to independent, assisted, and memory care facilities, the impact or the economic impact is different depending on the type of facility and their how they're getting paid. So private pay, there's no impact because there's no reliance on those federal or state programs. Hybrid facilities that receive some Medicaid but are not relying on that Medicaid, they'll have some impact, but a lower impact. But facilities that have a heavy reliance on Medicaid waivers, there's going to be tighter eligibility and cost sharing, which may impact the ability of a resident to go to that facility and be priced out. And that would impact the census or the occupancy within that facility and revenues. So facilities that are in that type of position, and we'll get into this a little bit later on, the actions that some facilities are taking would include cost cutting and looking at how they're operating their business. And we may see more conversions to private pay and less reliance on Medicaid. And remember that you've got this situation here where there's a lot more demand that's coming and less supply. So you've got people who are aging into the age demographic or group that is using assisted living facilities with uh, fewer beds or less beds to meet that need. So you've got this demand supply imbalance. So not necessarily too terrible to be in if you're able to convert to private pay. The operational impact is a little bit different again, depending on the type of facility. Private pay, there really isn't any impact. But again, those facilities that are Medicaid reliant, there's going to be a greater administrative burden where you've got enhanced documentation for eligibility. You've got to go through the renewal process every 6 months versus annually. So that requires better systems, reporting, increased education and training. So again, you might see a rise or a shift in conversions to private pay because of both the economic impact, but also the operational impact. Behavioral health facilities operate a little bit differently. The private pay individual, again, no impact, or private pay facility, I should say, no impact, but reliance on Medicaid. Many behavioral health facilities have a much heavier reliance on Medicaid funding. So if the cuts in Medicaid or the additional eligibility requirements would have a greater impact on behavioral health facilities that are in that type of situation. And those cuts come at a time when mental health funding is necessary specifically for young adults, for example. So those are the types of people that also fall into the work requirements as well. So the operational impact is similar to senior housing. If you're private pay, there really isn't any impact. But if you were heavily reliant on Medicaid, then you've got additional regulatory burden, and you're going to be helping your patients meet some of that paperwork and eligibility requirements. Quick spoiler alert, we don't have any behavioral health in our portfolio, so this doesn't affect us in the existing portfolio. Cross-operational themes. How does this affect these different facilities? Just as a sort of a recap, you've got eligibility and reporting requirements there. You've got that work exemption unless the individual is exempt. You've got semi-annual determinations, stricter documentation specifically as it relates to citizenship and income, shorter retroactive coverage periods. In other words, if somebody comes in and applies, it used to be that you could go retroactively to the date of that submission, 90 days. Now it's 30 days. So documentation needs to be a little bit more crisp and on point. You've got increased administration costs in terms of compliance and maintaining compliance with these different rules. And then you've got different financial strategies that may be put in place at this point. So what are some of the actions that people are taking here? Well, state governments, we'll start with those. Well, first and foremost, you heard a lot of public denouncements of the cuts and calls to preserve the programs. But states are also taking defensive measures as well. They're raising awareness, they're providing additional education on what happens, they're assisting providers with how to navigate the change in the rules. But in addition to that, they're also talking about and figuring out other ways to provide funding and budget planning to maintain the Medicaid services and reimbursements. So there are proposals on the table to backfill some of the lost funding of the federal funds through state funds, through different types of measures. So you'll see tax increases, or at least discussions about tax increases, reallocation or appropriation measures, reallocating from maybe education or climate funds, and other offsets and spending shifts to figure out some stopgap measures for what might be a loss in that funding. Others are expanding certain programs. Some states are trying to determine strategies to help immigrant seniors, and even some local communities are getting involved in figuring, can they trim services to help bolster what's going on with the need for senior care. Facility owners and operators are taking a number of different steps. First and foremost, they're getting educated, they're staying informed, they're engaging with their state regulators, they're auditing their resident population mix. They're looking to identify groups that would be impacted, such as non-citizens, dual eligibles, people who are cognitively impaired. They're determining what resident turnover might look like due to eligibility or ineligibility. Um, they're looking at their eligibility, infrastructure and reporting, verification, documentation, dealing with the shorter term windows. They're also tightening their admission screening, looking at those people before they become residents of the facility on eligibility and reimbursements. They are auditing and looking at their revenue streams, what percentage is coming from private pay, Medicare, Medicaid, Social Security insurance, other forms of payment. And they're starting to adapt financially, looking at things like diversifying their payer base. How do they optimize their payer mix? Portfolio rebalancing. If a group has a large portfolio of assisted living facilities and some that are more Medicaid reliant, do they sell or adjust those facilities? There's been news about some facilities actually putting a fund in place to assist with copay assistance. Some facilities are looking at grant funding. There's private pay transitions, stressing financial models, planning for potential attrition due to changes in Medicaid. So there's a number of things that they're doing to adapt. They're also looking at their care and coordinating the eligibility of services with reimbursement. And they're coordinating with social workers and community partners to support compliance with Medicaid, developing tracking systems and some wraparound services. They're partnering with legal aid, social work, and financial literacy programs to make it easier for residents in the facility itself to comply. More training for staff, and partnering to reduce costs such as billing and compliance. And then they're advocating at a state level to see if they can get a little bit more funding as well. The steps that Wilshire is taking, well, we've tightened our underwriting criteria and how we look at loans, how we look at facilities we're operating. We're also staying informed on what's occurring in the marketplace. We're reviewing and considering many of the same things that the operators are considering, quite frankly, in terms of the payer mix and their strategies. What the resident population looks like and high risk groups, revenue streams, financial adaptation, and is that viable for that particular facility? Care coordination, tracking systems, so on and so forth. So we're being very proactive about how we're looking at things in the marketplace. What about Wilshire's current portfolio? Well, we've been pretty conservative over the years and had very, very tight underwriting and have been very selective about the types of loans that we do. So we're pretty well positioned. Most of the facilities that we've got are private pay or a mixed or combined facility that has a little bit of reliance on Medicaid, but not much. And then we've got one facility that's a little bit more heavily reliant, but they're in pretty good shape. So we don't have any Medicaid only facilities. And as I mentioned earlier, we don't have any behavioral health in the portfolio. So the portfolio is performing, it's doing well. So we don't see any issues in the existing portfolio in the fund. So what is our Deal flow, what is our approach moving forward? Well, again, we've been conservative over the years. We've been very selective about the types of loans that we make. So we don't anticipate changing that approach in the marketplace. What we have seen is an increase in deal flow over the last 2 quarters. We're seeing more submissions coming to us, but the market is still very, very competitive for lending. In fact, we're seeing certain loan submissions or the same loan submissions coming through multiple channels, um, which means that brokers and borrowers are shopping very, very hard for the best financing that they can get. We're also seeing some retrading or additional negotiations between buyers and sellers when acquiring a facility. And that shopping and those additional negotiations stretch timelines out a little bit longer. So um, that translates into longer conversions for funding new loans as well. But we're seeing pretty good deal flow. We think that deal flow is sufficient, and I think we're in fairly good shape. Our strategic approach in this environment and our lending thesis hasn't changed. It's still bullish on bed sheds and beds, and including senior housing facilities. We adapt and adjust a little bit in that particular asset class. But moving forward, we're going to keep doing what we're doing, which is being conservative and being selective and making sure that we can mitigate risk while trying to generate some additional returns. So I've covered a lot of material here. And what I do want to do is open it up for questions. And if Laura or Nicole is there, if you can help me find these questions, that would be terrific. Okay. I see somebody has raised their hand. I'm not able to. Okay. Let's see if I can get that question coming in here. I'm sorry, I'm having a little bit of a challenge with the technology. Okay, I'm going to give it another minute. Q&A. Okay, first one, anticipate lowering rates. Do you think this will affect deal flow and fund profits? Well, lowering interest rates in the fund, yes, it will have a positive impact on deal flow because you become more competitive in the marketplace. And the way that the fund operates is that net income that comes from the interest earnings on the underlying loans is a pass through to the investors. So if the weighted average coupon in the fund goes down as a result of making a number of loans with lower rates, then you would see a trailing down in the income in the fund. It's sort of like a bank's loan portfolio where you're really looking at the blend of the different coupons that are in the fund. And if you've got higher coupon loans and lower coupon loans, but you're writing more lower coupon loans, you're going to see this trailing down. Conversely, what we saw was a trailing up as we were writing loans at a little bit of a higher interest rate. Um, let's see, what percentage of Wilshire's funding is directed towards these institutions? When I think you're talking about Wilshire, the institutions, I think you're talking about the senior living facilities, um, which would be your assisted living, independent, so on and so forth. Um, We've got, at any given point in time over the last 6 months, somewhere between 60 and 70% of the portfolio in assisted living facilities. And again, those facilities are predominantly private pay, and the portfolio is performing pretty well. Private credit got a lot of press recently. Will that increase competition, drive down future rates and returns? It depends. I mean, there are different forms of private credit out in the marketplace. It's a pretty broad category. Private credit would include middle market, business lending, as well as real estate lending. And when you're talking about specifically real estate-based private credit, there are different platforms, for example, that are lending in single-family residences or long-term rentals, so on and so forth. So it really depends on the segment that you're talking about there. But anytime you've got increased competition, um, there could be different impacts. So, for example, in the 2011 through about the 2013 timeframe, we saw a lot of institutional capital entering into the private lending market, specifically on single family residences. And what happened there was, and it continues today, is that they were bundling those private loans and actually securitizing them into bonds, so a transfer of risk. And with that transfer of risk, they were going out at much higher loan to values and much lower coupons, so taking on more risk with less return. Um, Today, we're seeing some people in the private credit market doing single family lending at 80 to 85%, even higher on the purchase price, and funding 100% of the rehab. So they're over um, the value of the real estate on their loan commitment on the day that they make that loan. So it's again, it's all over the board. With respect to senior housing, it's a more narrow market. There are fewer lenders in that market. There will be lenders that will enter that market. I'm not disillusioned there. There could be some impact, but I don't see an immediate impact over the next, call it 6 months or 12 months, that would dramatically have that kind of impact on the fund. Um, yes, senior living facilities was part of that original question. I hopefully addressed that. Follow-up question, assuming lending rates decline over time, we would expect that these lower quality loans still maintain sufficient added return versus higher quality loans. Well, I think that the loans that we're making are good quality. I don't think that they're of lesser quality. In fact, the loans that we see, and we see a couple of hundred inquiries a week, and we only make offers or put term sheets out on a handful of those because we are pretty selective. I don't think that based on how we're underwriting these loans and looking at both in-place cash flows and pro forma cash flows, and in-place loan to values and pro forma loan to values, we're not getting over our skis where we've seen that with other types of lending over the years. So, for example, multifamily capital was very, very cheap, 3 and 4% at a time when capitalization rates were 3 and 4%. You see a couple of 100 basis point rise, and you see a um, couple of hundred basis point rise in your capitalization rates. So your property value has gone down, your cost of capital has gone up, and it's difficult to refinance those, especially if you're pushing loan to values to be competitive and sort of fill a bucket. Our approach has always been a little bit different. It's look for higher quality bridge, quality over quantity, and maintain discipline in terms of our loan to values. So if there is, that kind of dynamic where interest rates go up and capitalization rates go up, there's less of an impact on the types of loans that we've got in our portfolio. And we've been through a couple of cycles with that, and it's worked out fairly well to this point. Our profits paid out monthly, yearly, or other. The way that the WFP income fund works is that um, The distributions occur on a monthly basis. Um, the opportunity fund is on a quarterly basis. Uh, what percentage of Wilshire's funds are in reserve and what is actively in play? That fluctuates because we do have new capital that enters the fund and then that gets deployed. We're close to full deployment at this point in time. We've been pretty close to full deployment for most of 2025. When we get loan repayments and an influx of new capital, we'll see that percentage come up and be in reserve. So for us, we're seeing opportunities in the marketplace. We do want to raise capital, but at the same time, we want to do it in a prudent way. I don't want to be sitting on way too much cash, but at the same time, we're seeing the ability to bring in additional capital and get that deployed. We're going to give it another second for more questions here. Okay. Well, with that, what I'd like to do is thank you all for attending. I appreciate the questions. And if there are other questions that you've got, maybe you want to get into a little bit more detail than what I've provided here today. If you've got questions specific to you or your investment, happy to answer those and uh, jump on a call with any of you. You can contact me. My contact information is on the screen. You can email me, you can give me a call. Happy to further the discussion with you. But again, thank you for attending, and we appreciate you entrusting us with your investments. Thanks so much.